What's up everyone, it's Caddy with Money Vesting. So in this video, we are going to be talking a little bit about these 5 cybersecurity stocks. So I'm going to be ranking them in a tier list format. So a little bit of a different style of video. So we are going to be doing a fundamental analysis on these companies. I'll break down my spreadsheet where I've pretty much spent the last hour compiling all the data for these 5 companies, and these companies are going to be CrowdStrike, Fortinet, ZSCALER, Palo Alto Networks, and Okta. So we're going to be analyzing these companies from a more fundamental standpoint. We'll take a look at the revenues, the profits, the margins, the earnings, the cash flows, shares outstanding, all those things. And then I will be ranking them based on what I believe is the appropriate ranking in this tier list. Now, what I've named this tier list, and as I'm sure you may have watched other videos in a tier list ranking for, gaming characters and weapons and all that stuff, like people do that, a lot in other videos. I've pretty much ranked these tier lists into buy, hold, and sell. So these are not recommendations, right? And just because I'm putting a stock in a buy column doesn't necessarily mean it's an immediate buy. Just because I'm putting this stock into a sell column doesn't necessarily mean that it's an immediate sell. It's just a fun little name that I've kind of put together, buy, hold, and sell, and just kind of ranking these companies. And I'll go over the thesis behind that as well, and what's the main reasoning of me ranking these stocks in that tier. So I hope you guys enjoy this video. Again, it's going to be a little bit of a different style video. I'm shooting in the dark here. So let me know in the comment section down below if you enjoy these types of videos. I'm going to be doing maybe more if the feedback's good. I'll be doing some semiconductor comparisons and ranking the semiconductor stocks, maybe energy stocks, defensive companies, tech growth. The opportunities are pretty much endless. So there's a lot of potential rankings and tier lists that we can create if you're interested, of course, in these types of videos. So let's just dive right into it. Make sure that you drop a like, and of course, don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. If you're interested in joining us, the first week of the month, usually the best time to join, get access to all the alerts, all the trade ideas, swing trading ideas, and of course, not to mention the private videos in our Patreons as well. So the link's going to be down below. So this right here is going to be our spreadsheet. I've kind of broken it down into Fortinet, Palo Alto Networks, CrowdStrike, Okta, and ZSCALER. So one by one, we're going to analyze every single company and then really take a look at, where I would rank these companies on that tier list. So first up is going to be Fortinet. So Fortinet is, one of the best cybersecurity companies out there, at least in my opinion. Their revenue growth is obviously not comparable to all the others in the industry, but they are one of the slower grower in this industry. So just a little bit over 24.5%. And this is, by the way, revenues coming in since, 2013, 2015. However far back I was able to find the data for. For example, Fortinet, we're looking at 9 years out, right? So this is going to be for 2013. This is going to be for 2022. $4.4 billion. That was a growth of 24.5%. Gross profit grew by about 25.5%. Operating income, so they are profitable, went from $72 million to over $965 million, up 33.4% on a compounded annual basis. So very strong growth in my opinion. And they are actually one of the only ones in this list that is actually profitable, right? So they are the ones that are generating net income on both GAAP and non-GAAP basis. And that's a CAGR of almost 39%. So pretty strong growth there. And they're also one of the only ones in this list that has consistently been buying back shares over the last 9 years. So their share count has gone from 841 million down to $805 million. So pretty much going down 0.5%. EPS has grown from about 5 cents to over $1.05 per share. So that's a 40% CAGR over the last 9 years. Pretty good growth. And free cash flow from 96 million to over $1 billion. That's a 30% growth over the last 9 years. And balance sheet is also good. So they're sitting on more cash than debt on the balance sheet. Current ratio is over 1. So current assets do exceed current liabilities. Total assets slightly lower than total liabilities. So that's actually quite surprising that they're the only cybersecurity company that has more liabilities than total assets by a small amount. And debt to free cash flow really doesn't matter because the company has more cash than debt. So in other words, they have a negative net debt. So it doesn't really matter what that debt to free cash flow number is. Their 5-year growth rate is going to be a little bit over 20%. That's what the forecast is based on analyst estimates. And that's what analysts are expecting. In fact, that's going to be the 4-year CAGR because I was only able to find the earnings expectations all the way out to 2027. And in terms of valuation, they definitely do trade at a little bit of a higher multiple, but on an absolute basis. On a relative basis, though, they are one of the lower ends of this company because other cybersecurity companies, you'll notice, are trading at a much higher valuation. We'll get to that in a minute. But Fortinet definitely trading on an absolute basis a little bit higher, relative basis a little bit lower compared to some of these other companies, and trading at just over $58 per share. Now, my fair value, if I remember correctly, was sitting at closer to $40, a little bit under $40. So this is going to be an easy ranking for me because Fortinet kind of hits all those check marks. And this right here, again, is going to be our wonderful chart, and Fortinet definitely goes into the buy column because buy ranking, because it pretty much checks off all the boxes. You've got an excellent balance sheet, you've got a consistently growing business, revenue, earnings, great margins, and you've got consistent share buybacks. Valuation is the only thing that's a little bit high, but from a long-term perspective, I would certainly be considering as a potential buying opportunity for Fortinet if and when it actually drops down to that level. Again, these are quite meaningless. Again, buy, hold, sell doesn't necessarily mean that that's exactly what we're doing, but just to give you a good visual representation on where I pretty much stand with these companies. Next up is going to be Palo Alto Networks, and Palo Alto Networks is kind of like considered as the second best next to Fortinet, at least in my book, because this is another company that is literally on the verge of profitability. They're very, very close. So $396 million to $5.5 billion, much faster growth than Fortinet, and they've got the 9-year CAGR down to 34%, much higher revenues, much higher growth rate, much higher gross profit, $3.7 billion, you'd imagine, because they are generating over $1 billion more in revenues than compared to Fortinet, and then 33% growth in gross profit. Operating income still negative, unfortunately, for the company, but they are very, very close. I actually did a video on them, more specific, more dedicated video on them not too long ago, and they're very close to generating some profitability, perhaps in 2023. So net income also negative. Unfortunately, we don't have a lot of analysis on that front. And diluted shares outstanding, this is the second best because they're not diluting shareholders by a lot. I mean, it's gone from 206 million to up to 296 million. And that's considering the last 9 years. So Palo Alto Networks actually done a really good job in making sure they're not issuing a lot of shares. Stock-based compensation is a separate story, but they are definitely not issuing a lot of shares in the market to raise capital. So only 4% dilution every single year. And EPS is still negative. Like I said, they're definitely on the verge of profitability here. So hopefully in 2023, we'll see some profitability from Palo Alto Networks. And then we've got free cash flow, very strong, right? Strongest among most companies, except for Okta, I believe, is much higher. Or ZSCALER. ZSCALER is much higher in free cash flow growth compared to both Fortinet and the company that we're looking at, Palo Alto Networks, but 43% growth, right? 43.5% growth since the last 9 years, since 2013. And the balance sheet's also good. However, they do have some issues with current ratio. So their current liquidity, so 0.64, that is something the company definitely needs to manage. And the part of the reason is because a lot of their long-term debt is now due under 1 year. So it's kind of moved up the balance sheet from long-term assets to long-term liabilities to short-term liabilities. So it's pretty much moved from non-current liabilities, in other words, liabilities that are due over a year out, to current liabilities. So that debt is due in under 1 year. So they might reservice that debt. In other words, they might, take on more debt to kind of pay that older one off and kind of reservice it that way. So this number might increase in the future. So it's not really that much of an issue because the company does have more cash than the overall debt on the balance sheet, but it's just on a short-term liquidity basis. They're definitely struggling a little bit. So that's something of a bit of a concern, not a huge deal, but definitely something to pay attention to. Total assets do exceed total liabilities, and debt to free cash flow is under 3, also very strong. And the EPS growth for the next 5 years expected at 22%. And they're also the second in terms of the valuation for where they're trading. So market price obviously $186. And when I did the analysis on Palo Alto Networks, I have to go back and take a look, really where the price was, where the intrinsic value was. But if I'm not mistaken, it was closer to 130s, might have been even lower in the low 100s. I would not be surprised. But right now, it's definitely a little bit on the overbought side. Considering how much it's pushed up already from its lows of about $132, it's definitely pushed up over 43%. So putting Palo Alto Networks is going to be, for me, in the hold section. It is a phenomenal company, definitely worth looking into, and it's a company that in my opinion, is going to potentially turn the corner towards profitability. I could even put this in the buy tier, buy ranking, considering how strong that growth is, and it's it kind of checks off most of the boxes, not all, but most of the boxes it checks off. It's just that profitability needs to happen for Palo Alto Network, and as soon as that happens, I think it'll definitely move up to that buy ranking. I can even be there now, but just considering the technicals, considering the profitability and that current ratio, it's more of a hold situation where you got to wait and see how this all plays out in 2023 for Palo Alto Networks, and can they turn the corner towards profitability? And if so, they're definitely going to get moved up to the buy ranking section. But for now, I'm going to keep them on hold. So next up, we've got CrowdStrike, I believe. That's going to be, CRWD. Revenues, exceptional growth. That's the most out of all 5 here, 107% growth in revenue. Gross profit, 140% growth, going from 19 million to over almost $1.5 billion. And then we've got, negative operating income, in other words, operating loss, net losses pretty much generating, right, $178 million in net losses, and shares outstanding the most. This company has diluted shareholders left and right, 41% increase in shares outstanding for this company, from 40 million to over 227 million shares. And the EPS obviously has narrowed over time, but it's still negative. And then free cash flow has gotten positive, but it was negative, of course, in the beginning, 2013, 2015, around those times, negative $35 million, but they are now sitting at $658 million in free cash flow. So we don't really have a compounded annual growth rate, but we know that it's turned the corner towards profitability in terms of free cash flow. Cash sitting more than debt, so it's got the best balance sheet out of all, more cash than debt, negative net debt, 1.78 current ratio, total assets also exceed total liabilities, debt to free cash flow 4.76, so a little bit on the high end, and we got a 5-year CAGR at over 43%. So there is expectations that they are going to be able to grow earnings to over $6.39 by 2027. So there is expectations that they are going to be able to generate profitability over the long term and turn that corner. However, the valuation right now, at $120 per share, it just does not make sense for it to be trading at over 80 times earnings, right? 80 times earnings, 12.5 times sales. Unfortunately, with this valuation, it's just not going to be a potential buy. It's just way too high, right? Even though the expectations are that CrowdStrike eventually is going to become profitable. Let's just take, for example, 2027 numbers, right? $6 is going to be that EPS, 120 divided by 6. It'd be trading at 20 times earnings on 2027 basis, right? 2027 basis is trading at 20 times earnings. Right now, as it stands, it's trading at over 80 times. And these are non-GAAP forward. These are the most generous time earnings analysis here, right? Because we're looking at non-GAAP, right? So we're kind of adding back all the non-cash expense, stock-based compensation, all those things, right? And we're looking at forward. So we're looking at the next 12 months worth of earnings. And even then, CrowdStrike trades at a really expensive valuation at 12.5 times sales and 35 times cash flow. So, considering this, unfortunately, I will have to put CrowdStrike in the sell tier, even though I don't want to, but unfortunately the valuation is a little too high and the profitability is still a bit of a question mark. They've got a great balance sheet, no doubt, one of the best balance sheets, one of the best growth rates. However, the execution's lacking a little bit, and the amount of share dilution that we have seen, 41% for this company, definitely in the sell rating here right now, but things can change in the future, I promise. These are not set in stone. Things can and will change in the future, but just wanted to put them in that tier list for now. Next one on the list is going to be Okta. Okta actually reported earnings today, and they are up 17% right now. So they are pushing higher, 14.5%. So definitely getting a huge gap up. They reported earnings of 30 cents per share. So earnings per share coming in profitable with $510 in revenue. So I'm going to quickly break that down. So Q4 non-GAAP earnings, revenue increases, and sets guidance for the Q1 full year. So revenue came in at $510 million, up from $383. And EPS on a non-GAAP basis came in at 30 cents per share, up from 18 cents same time last year. And analysts were expecting 9 cents per share. So that's a huge beat. And the company said it expects Q1 non-GAAP earnings between 11 and 12 cents per share on revenue of $509 to $511 million versus the average analyst estimates of about 1 cent of loss and revenues of coming in just under $500 million. Now, in the full fiscal year 2022, earnings per share 74 to 79 cents per share and revenues of over $2 to $2.17 billion. So if you take into account that number, 74, 75 cents, and right now the market cap is 11.4 billion, price is $81. If you do the math, 81 divided by 75, there you go. I'm not even going to try. 108 times earnings on a forward basis for Okta. And right now the valuation is currently at about 11.4 billion. We multiply that by 1.14 because it's trading higher, 14% higher. So that's a $13 billion market cap divided by $2 billion in forward sales or the next 12 months, 2023 sales. And we're trading at 6 times sales for the company. So that's where we are, 61% growth in revenue over the last 7 years. We've got gross profits growing at 68%. That's the second best next to CrowdStrike. Negative earnings, negative operating losses here. But looks like the company is turning the corner. So once again, if you come down here, every single year they've been generating losses, but looks like they are once again moving in the right direction. And we just learned that Q4 non-GAAP earnings was profitable, and diluted shares, unfortunately, 38%. So that's a lot of dilution from this company over the years. And free cash flow, again, profit positive. So $500 million in positive free cash flow, but still, we don't have a CAGR here because they were coming from negative free cash flows to now positive. Cash to debt is good. Current ratio is good. Total assets to liabilities are good. So they've probably got the best balance sheet out of all. I don't have any complaints next to CrowdStrike. And the 5-year growth rate is very strong at over 99%. And they are expected to generate over $4.30 by the year 2027. And again, that's going to be on a non-GAAP basis, and they just guided for 74 cents in 2023. So if you take into account, let's just do 74 cents here, 0.75, and we're going to be looking at 3 years because 2023, 2024, and 2025, 2026. That's still going to be 4 years. Actually, that's going to be probably 5 years. We're looking at 41.8% growth from the company over the long term. So that's kind of came down a little bit considering that they are expected to generate profits this year. That's why as numbers get bigger and bigger, growth rates do come down. So on a forward basis, we just got the numbers today. I'm going to update those, 108 and trading at 6 times sales and 155 times free cash flow. The valuation is just way, way too high with a lot of share dilution. Balance sheet's good, growth rate's good. However, it's just going to be way too high for valuation. So I'm going to have to put this in the sell rating as well as a ranking for sell. Again, doesn't necessarily mean that it's an immediate sell here, but we're going to have to wait to establish a position in this company because long term, they can be successful, they can execute, and they can turn the corner, but the valuation's way too high with a lot of share dilution coming in. So unfortunately, that will be a sell rating, a ranking. Next up and last up, we've got ZSCALER, and ZSCALER, pretty good revenues. They're actually reporting earnings tonight, so after the bell, they are going to be reporting their numbers, but $54 million to $1.2 billion. It's a 56% growth there. Gross profit has grown 42%. Operating loss has now turned into an operating income, $321 million, but still generating a net loss. So ZSCALER is one of the two companies, Fortinet and ZSCALER, are the only ones in this list that are generating an operating income, but Fortinet is the only one that's actually generating a net income. So we're going to have to put ZSCALER here. And CAGR for net income, 43, 45%. It's only widening, getting worse, unfortunately. And shares outstanding growing by 22% per year. They've gone from 24 million shares to over 142. This is, I feel like, one thing that not a lot of people pay attention to. You definitely need to pay attention to this because if the company is issuing a lot of shares, that's only increasing supply in the marketplace, thereby reducing shareholder value, right? It's really, really important that companies are buying back shares, even if they are issuing shares. Like, for example, this one right here, this is Palo Alto Networks. It's quite reasonable. 4% is actually not that bad. But once you get up to double digits, it becomes a little bit of an issue, right? Because you're now diluting shareholders. You're taking them for granted. You're taking advantage of shareholders by raising capital there. Free cash flow, very good growth, 98% growth there. We got an excellent balance sheet, more cash than debt. Almost every single company has more cash than debt here. Current ratio is also good. We got total assets exceeding total liabilities. Debt to free cash flow is a little bit over 4. Doesn't really matter because we've got more cash than debt. And 5-year CAGR is going to be almost at 40%. And their expected EPS is going to be $4.72. And 128 is where we are right now. So 128 divided by 472, 27 times earnings is where we would be for ZSCALER based on 2027 numbers. So 12 times sales, definitely very, very high. We got 103 times earnings, and price to free cash flow trading at over 50 as well for the company. So unfortunately, this one also would have to go down in the sell rating because it's definitely trading at a very high valuation with respect to what its sales and earnings are. So that's going to be the final list here. Let me know your thoughts and if you would make any changes. Again, these are not recommendations, not saying buy this, hold this, or sell this, but this is simply just a good visual representation. We can also put this as like, let's say an S tier, which is going to be at the top tier. Then we got an A tier and we got a B tier. We can also make those changes here, and that wouldn't make a difference because these are not recommendations, but instead I'm telling you like the quality of the companies as of today. So Fortinet definitely comes out on top, and then followed by Palo Alto Networks. I absolutely love Palo Alto Networks more recently as they have reported earnings and they're starting to turn the corner. But these three companies definitely have a lot of potential, but they need to improve on not issuing so much shares and at the same time also turning the corner towards profitability in the future. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Let me know your thoughts on these five companies and if you would make any changes here. But ZSCALER here coming down a little bit. Support level is going to stay put at about $100 per share for this company moving forward. So, and they are reporting earnings later today. So as always, happy investing. And if you want more videos like these, let me know in the comment section down below. Happy investing. I'll see you all in the next video.